Welcome back, guys, to another enlightening tutorial about one of the most popular options strategies on the planet, covered calls. If you're looking to limit your risk and increase your chances of profitability, this strategy will be perfect for you. Best of all, it's available on the Robinhood app, commission free. For those who can begin to understand the benefits of options, you know that using covered calls can enable traders to produce significant profits with secured downside protection. If you listen to the financial talking heads of CNBC and other similar channels, they may call strategies like this conservative equity based investments, but those labels only serve to confuse you. A covered call isn't as hard as you think. It involves writing a call option, aka selling a call option, against a stock that you already have in your brokerage account. The buyer on the other side of this transaction has the right to, quote, call the stock at a specific price because he or she is paying the seller of the contract a fee for agreeing to provide the underlying shares if the option is exercised. We will go over an example to help you understand this, but essentially, this strategy is incredible if you're looking for an above average return with massive downside protection. Because the call writer, aka call seller, delivers the shares directly from his very own portfolio, his short position is, in other words, covered, meaning there is no risk for the call writer, aka call seller, of being forced to buy and then immediately sell shares of stock at a premium after it already has experienced a massive increase in value. All of this may sound confusing, so let's dive into this concept further. Once you understand the ins and outs, you will begin to form the complete picture. Covered calls are one of the most incredible strategies used by investors today, and the math behind them allow you to put yourself in a safe yet formidable position, unlike many other option plays that present significant dangers and risks. If you're browsing on Wall Street bets or just getting into options, plays such as simple calls or puts may sound appealing because they are simple and they can return some pretty incredible profits if your play goes your way. Trades like simple puts or calls lean more on the side of gambling rather than that of strategy. Like the vast majority of those entering the options game, you will eventually face significant loss because with plays like these, there is no downside protection, meaning if a play doesn't go your way and a stock suddenly experiences a move contradicting your prediction, your money is gone within seconds, a 100% loss. Eventually, you will learn either the hard way or the easy way that a strategy is required if you want to make profits long term. Covered calls are a great first step, and as I will explain later, they cover all the required bases, limiting risk while giving you the potential to earn an above average return. So let's begin with an example. Let's say John is a trader who is looking to use covered calls. The first thing he's going to do is purchase 100 shares of a stock that he plans to implement with this strategy. This may sound more capital intensive than what you're used to, but if you're going to keep things cheap, consider this strategy with stocks that trade under $10. In our example, we're going to go with GE, which is currently trading at $9.44 per share. Remember that a covered call position involves writing, aka selling a call option, against a stock held in your brokerage account. If you're selling one contract, that represents 100 shares of stock. So we begin our strategy by buying 100 shares of the stock we plan to cover. Like mentioned earlier in our example, we will be using GE for now. But before I tell you what GE stands for, please don't forget to hit the subscribe button if you're enjoying this video. General Electric is relatively cheap, yet the options market associated with it sees very high volume. This makes it a great candidate for a covered call, especially for someone like John, who's using a relatively low cash balance. GE at the making of this video is trading at $9.44 per share. If we purchase 100 shares, our total cost will come out to $944. Step 1 complete. Now in order to finish this move, we will sell one call option slightly out of the money and about a month away from expiration. In our example, we choose to sell the $10 strike expiring June 28th. This move would credit our account $24. Okay, so what's the scenario? What happens if GE stock goes up or if it goes down? For this question, we go to our favorite website, Options Calculator, and we look at how the profit loss chart will look given a certain price and time. As you can see, if the stock finishes above $9.22, we will be profitable. The downside to this strategy is clearly visible by looking at the green areas. Profits are capped off. If GE raises above $10, we will make an 8.5% return max. It doesn't matter if it finishes above 11, 12, 13, or 50. Our maximum profit is capped at 8.5%. On the other hand, this strategy also limits your losses. In theory, if GE became worthless in this period, we'd lose 100%. But a close look at the red areas shows that even if GE fell to $8.50, a significant loss for a month, we'd see only a 6.5% loss to our $944 investment. Your chance of profit in this type of play is very high, and consistent wins raise your confidence and your account balance. 6 to 8% may not sound like a lot, but a stretch of these types of plays over the course of a month can significantly increase your account while limiting your potential losses. On top of this, using a covered call allows you to achieve a profit even if GE were to slightly go down. Looking closely at the chart, even at $9.30, we would make a small profit. And of course, with this strategy, you can close the position early. This allows you to create consistent small wins. Although it may sound boring and ineffective over the long term, these 7 to 8% wins add up quickly. Covered call strategies, especially in today's hectic financial environment where one tweet or one trade event could significantly alter entire markets, make for perfect moves, ensuring against significant losses while also raising your chances of consistent profits. In fact, buy right strategies, such as these, have been consistently used and are well studied by financial experts. In one study in particular, named Finding Alpha via Covered Index Writing, authors Joanna Hill, V. Blusbarian, Buzz Gregory, and Ingrid Tyrians look at the historical risks and returns of writing covered calls on indexes. We know that historically, the S&P 500 has returned about 9.7% annually. Now, if we find an index fund, such as the SPY, and we write covered calls on it, you can imagine what happens. It's like a cheat code, reducing risk while improving returns. The authors of this study in particular conclude with the following phrase: these strategies have very favorable performance characteristics at a range of risk levels. Because of the presence of an equity risk premium and the goal of higher returns for equity-based strategies, we recommend strategies at least 2% out of the money with a 30% or less probability of exercise. If you look at their study, which is linked in the description below, depending on the time period, you can see that implementing their guidelines, one can realistically look at 10% returns with consistent cash flow. Essentially, covered calls act as low-risk enhancement policies that everyone should deploy once they understand how they work. Thank you guys for watching. Please don't forget to hit that like button if you enjoyed the video. YouTube's algorithm and my channel will greatly appreciate it. And if you're looking to get a start with covered call strategies, there is no better place to try them, commission-free on Robinhood. Please consider using my affiliate code linked in the description below. You and I both have a chance to earn a free stock valued up to $200.